Hello and welcome back to the next part of our online reviews. Today we're going to be covering Chapter 3, which is operating decisions and the statement of earnings. So let's jump right in. So today we're going to answer a couple of questions. The first one is, what is the operating cycle for a business? So the operating cycle, we're then going to cover what elements or what accounts are on the statement of earnings. We're going to be covering how we record transactions related to an entity's operating activities. So if you remember in the last review session, we covered how to record the purchase of assets, the increase and decrease of liabilities and equity accounts. And today we're going to be covering how we actually record transactions relating to operating activities on a day-to-day basis. And finally, we're going to be building a statement of earnings. So let's talk about the business operating cycle. So the operating cycle is the cash-to-cash cycle. If you recall from the previous lessons, we discussed what the operating cycle is. So the first step is that a company, an entity would purchase, they would purchase labor or materials. The next step is the company would produce goods and or services. Then we would sell them to customers. And finally, we would collect cash. So if you look from the beginning of the cycle, we start off with cash. And through this whole process, we end up collecting cash and we repeat. So what would Java Joe's operating cycle be? So Java Joe would start off, right? They would hire employees, they would buy coffee beans, they would buy milk, maybe they would buy, pastries to sell in their coffee shop. Then they would, make coffee, they would make lattes, whatever the customers want. Sell it to the customers, collect cash, and repeat. So that would be Java Joe's operating cycle. We'd also like to discuss the periodicity assumption. So this is very important. It is an assumption that the life of the company can be broken down and reported in shorter periods. A company can exist 5 years, 10 years, 100 years, even longer. There's some companies that have been around for hundreds of years. But under the periodicity assumption, we assume that we can break down the life of the company and report it in shorter periods, whether that would be months, quarters, right? Which is 3 months, or years. So let's talk about the different elements on the statement of earnings. Okay, so we're going to look at the different elements on the statement of earnings, and we're going to look at them from the top down. So the top line on the statement of earnings is sales revenue. So this is all of the sales of the company. Next, we have the cost of sales or cost of goods sold. So as you may recall, this is the expense. So it is an expense of the inventory or goods we had to give up to make those sales. So I'm going to write that a little bit more neatly, but in order to make sales. So if we look at this from the perspective of Java Joe, their sales revenue would include all the sales of coffee, whatever drinks they sell. The cost of goods sold would include everything from the coffee beans to the milk to whatever goes into the actual product, the goods that were sold. It doesn't include other costs like labor right away. So the sales revenue less the cost of goods sold equals the gross profit. That gives us our gross profit. And so that is after accounting for the cost of the inventory or the goods that we gave up, what is the cash or the revenue that we received from our customers? And this is our gross profit. And this is the amount that we use to pay off all the other expenses in the company. We then have our operating expenses, and this can include stuff like our wages or salaries expense. It could include rent, advertising. It can include depreciation. It's basically all of the expenses that go into the day-to-day operations of the company. So when we have our gross profit less our operating expenses, that gives us our operating income. So that is our income after we've paid off our inventory and after we've paid through all of our regular expenses. Another term for operating income, which you may have heard, is EBIT, which is our earnings before interest and taxes. We would then have our other revenues and expenses, and these are our gains or losses, and we're going to cover what those are in further detail later on. But these are revenues or expenses that are not part of ordinary business operations. So what do I mean by that? Let's say, for example, we own a restaurant and we do delivery. So we own a couple of delivery vehicles and we sell one of our vehicles at a gain. Our business is selling, pizzas or food or whatever our restaurant serves, but we're not in the business of selling vehicles. So that would be part of a non-regular revenue. It's not part of our regular operation, so that would be included there. We would also include non-regular expenses, so if there was a flood or if there was anything out of the ordinary. We'd also include stuff like our financing costs, paying off, the interest on a loan. After, accounting for our financing costs, etc., we have our earnings before income taxes. After this, we would then calculate our income tax, at least for this class. It's a lot more complicated in real life, but just for the purposes of COMM 217, this is where we would calculate our income tax expense. And so we would then subtract that, and that would give us our net earnings or our net loss if we were not profitable. And at that point, on our income statement, we would put our EPS, our earnings per share. And we're going to cover what that is in greater detail later on. So what I've put here is from your textbook. I've included an exhibit, if you recall, from the previous review sessions. And here is a list of some of the common revenue and expense elements. So if you take a look, we have our sales revenue, right, from selling products, fee revenue, interest revenue, right, if our company has actually lent money, we can collect interest, rent revenue if we have rental properties, or service revenue. Maybe we're not selling coffee, maybe we're an accounting firm providing accounting services. So we would have service revenue because we've provided a service. And some of the common expenses, cost of sales or cost of goods sold, wages, rent, interest, depreciation, advertising, insurance, repair, income tax. So these are the most common revenue and expense accounts. So what I'm going to do is I'm going to actually show you the proper format on how to write out a statement of earnings. So as you may recall from previous review sessions, the first thing we do is we start off with the title of the company, and this is very important. So the first thing we do is we put the name of the company. So the company we're doing now is going to be ABC Corp. And we are creating the statement of earnings. And before, when we created our statement of financial position, we wrote as at because it was for one specific point in time. Our statement of earnings records a period. It could be a month, a quarter, a year. So we would write for the year, for the period. So for the year ended, and we'll say that this ended December 31st, 2016, and it was in dollars. So the first line always on your statement of earnings should be your sales revenue. And you start off with a $sign for the first line. And if there were any sales discounts given, you would put this here, right? So less sales discounts. And we will put this in brackets. So on your any financial statement, if you put an amount in brackets, it shows that it is decreasing from the line above. And we would then put our sales revenue net. So it is the net amount. We would then subtract our cost of goods sold. And this would give us our gross profit. And as I mentioned before, this is the amount that we're going to use to pay off the rest of our expenses. So let's continue. We would then put our operating expenses. And so this could be stuff like salaries, depreciation, etc. So we're going to put those amounts here. We're going to subtotal them. And we're going to put our total operating expenses on this side. That gives us our operating income. And we're just going to continue up on the other side over here. So we were at our operating income. And we will then subtract our financing costs. You can also write, interest expense, etc. And that gives us our earnings before taxes. The next line would be our income tax expense. And we put that in brackets because we are subtracting. And that would give us our net earnings. And we put 2 lines at the bottom to show that this is the final total. 1 line in accounting would mean a subtotal, and 2 lines means it is the final total. And we then put our earnings per share. And we will explain what this is in further detail later on. So this is basically what it would look like. Just important to mention that another term for statement of earnings, right? So we have our statement of earnings. Another term for it would be the income statement or the P&L, profit and loss statement. So it's very important for us to cover what the accrual basis of accounting is. So we're going to talk about that now. The cash basis versus the accrual basis of accounting. So in financial accounting, we follow the accrual basis of accounting. And we're going to talk about what the difference between the two is. So we're going to make a little table, and this is going to be explained very clearly to you. So we have the cash basis, and we have the accrual basis. So in the cash basis of accounting, we only care about receipts and disbursements, meaning when we receive and when we spend cash. And that is how we recognize a revenue or expense. So for example, in the cash basis of accounting, we recognize a revenue when we receive cash. And we would recognize an expense when we spend cash. We do not follow this in financial accounting because it is not representative of how businesses actually work, and the cash basis is more subject to manipulation. It doesn't really reflect when revenue was earned or when an expense was incurred. The accrual basis is a lot more reflective of what really happened. So under the accrual basis, we recognize a revenue when it is earned. So we're not concerned with when we actually receive the cash. Under the accrual basis, when a revenue is earned, we recognize it. And it is the same with an expense. We don't care when we spent the cash. Rather, we recognize an expense when it is incurred. So while the cash basis is focused on receipts or disbursements of cash, the accrual basis is actually focused on the actual event. When did it happen? When was the revenue earned? When was the expense incurred? So another important thing to recognize for the accrual basis is the revenue principle. You may ask, how do we actually recognize revenue? When do we know? So we recognize revenue when these 5 criteria are met. The most important is that the risks and rewards of ownership have been transferred. That is the big one. That once you have transferred the risks and reward of ownership of an item, you can say that it has passed on to the buyer. The entity no longer has control of the goods, so we no longer have control over it. The amount of revenue can be measured reliably. So we know roughly what we're gonna, or quite reliably what we're gonna receive for the good or services. It is probable that the benefits associated with the transaction will flow to the entity, meaning we reliably believe we will be paid for actually providing the good or service, and the costs incurred with respect to the transaction can be measured reliably. And so when these 5 criteria are met, we can actually recognize revenue. So let's look at some journal entries to record revenues in different situations under the accrual basis of accounting. As you recall, under the accrual basis, we care when the revenue is earned. So this means that it doesn't necessarily line up neatly with when we receive cash. So what we're going to do is we're going to record journal entries to record revenues in different situations depending on whether we receive the cash before or after. So first, we're going to do some journal entries to record receiving cash before the revenue was earned. So that's going to be the first situation. So cash received before revenue was earned. So the first step, right, we debit cash, which is an increase to assets because, we received cash, but we haven't earned the revenue yet. So in a sense, if we've received cash and we haven't provided the good or service yet, we owe the customer a good or service or that cash. So it actually creates a liability for the company. So we would create a liability account, unearned or deferred. You could write deferred also. Revenue. And this is an increase to liabilities. Then when we earn the actual revenue, we would debit unearned revenue. So we would decrease the liability, so we debit, and we would then credit sales revenue to recognize that we actually earned the revenue now. So in the first part, we have the cash that we received, and in the second part here, we actually earn it. So the cash is over here, and we actually earned it in the second part over here. Okay. Next, we're gonna do a journal entry to show when we receive cash at the same time it was earned, that the revenue was earned. So we would debit cash, right? So it's an increase to assets, and we would credit sales revenue, which is an increase to equity. So that's a lot more simple, right? It's very straightforward when you receive cash at the same time it was earned. And finally, we're going to show what happens when you earn the revenue. So when you earn revenue before receiving cash. So the first thing we do is we would debit accounts receivable, so AR. You may also have seen in your textbook or heard in class trades receivable. That's also acceptable. So you debit AR, and that is an increase to assets because it is the promise of receiving cash in the future. So you have a future economic benefit from it, so it's an asset. And we credit sales revenue right away. So that's an increase to shareholders' equity. And so this here, we've already recognized the revenue, even though we haven't received a penny yet. Then when we receive the cash, we would debit cash, so it's an increase to assets, and we would credit accounts receivable, so that's a decrease to that asset account. And this here actually recognizes or records the receipt of cash. So if you take a look, there's a couple of different ways this can go about, and it's always important when you're doing your journal entries to just think, what's going on? Am I receiving cash now? Have I earned the revenue yet? And these will be the three situations. We should also discuss the matching process, and this is a very important part of the accrual basis of accounting. We want to record expenses when they are incurred to earn revenue. So we want to hold off on recording expenses in order to match them up with the revenue that they have been expensed to generate. For example, when we purchase inventory, presumably we're going to sell it at some point, we do not expense it right away until it is sold because we want to show the users of financial statements and we want to demonstrate how that expense of inventory was used to generate certain sales revenue. So let's look at a journal entry to record sales and cost of goods sold together, and we're going to show you how we match it up. So let's say, for example, we sold inventory for cash, and we'll say it was for $1,000, and the inventory, we paid $500 for it. So the first thing we would do is we would debit cash that we received, so it's an increase to assets of $1,000, that's what we sold it for, and we would credit sales revenue, which is an increase to shareholders' equity of $1,000. And so that is the first part of the entry here, and this is to recognize the sale, right? This is the revenue, the sale. We would then add to this journal entry, we would debit cost of goods sold or cost of sales, and that is an increase to our expenses. And how much did we pay for the inventory? We paid $500. That's what the inventory cost us. So we expense $500 on our income statement, and we credit inventory. So that's a decrease to assets of $500. So if you look at these journal entries, what we're showing is that this $500 here of cost of goods sold, this expense is what we used to generate $1,000 worth of sales. So we're just showing people that by selling $500 of inventory, we've actually generated revenue of $1,000 for the company. So we're now going to look at a couple of journal entries to record expenses in different situations. And by different situations, I mean, like with revenue, whether we're going to talk about whether cash was received first or whether we spent cash, etc. So it's important to always focus on when the cash was received. So we're first going to talk about a situation. We're going to talk about a situation where we paid cash before expense was incurred. So the perfect example for this is a prepayment, right? Let's say prepaid rent. If you paid rent in advance for a year. So let's say we paid for rent, right? So we're going to debit prepaid rent. And this is an increase in assets. So let's say that was for $1,000 and we paid cash, so we decrease our cash for $1,000. Now, prepaid rent is an asset because it has a future economic benefit for us. If you recall the definition of an asset, it has a future economic benefit. So by paying for rent in advance, we have the future benefit that we're going to be able to use, this space that we've rented for our business. But now, when it comes to the end of the period and we've quote unquote used up the rent, we've actually stayed there, we've used it for our operations, there is no longer a future economic benefit. So we now expense this. So we would debit rent expense. So that is an increase to expenses of $1,000, and we credit prepaid rent. We've used up the asset. There is no longer a benefit for us. And so just to point out, these entries here in green, these are all on our balance sheet. Well, this purple one here is on our income statement, right? Because our assets, liabilities, and equities go on our balance sheet, our statement of financial position, while revenues and expenses go on our statement of earnings, our income statement. Now let's talk about a situation where we pay cash for an immediate expense, right? For an expense that we're incurring right now. So let's say we've paid, for advertising, and we're going to use it up in one shot. We're going to use it right now. So we would debit advertising expense. So it's an increase to our expenses. Let's say $500. And we credit cash. So that's a decrease to our assets. And as mentioned before, this is on our income statement. And the cash is on our balance sheet. And now let's look at a situation where we have actually incurred an expense before paying cash. So a common example of this would be wages or salaries of employees. We don't pay our employees every single day. We pay them, every 2 weeks, as you may know from your jobs, that you get paid every 2 weeks. But you've actually earned your salary, so the company has actually incurred an expense every single day you work. So expense incurred prior to cash. So we would debit the expense right away. So let's say wages or salaries expense. So that's an increase to our expenses. Let's say $1,000. Now the company owes this money. So we actually have to create a liability, a payable. So we would credit wages payable. It's increase to liabilities. So in this situation here, actually, the company has decreased their income, right? Their expenses have gone up and their net earnings have gone down, but they haven't spent a penny yet. Then when it comes time to pay you on payday, they would decrease wages payable. So it's a decrease on liabilities. And they would do this by paying out cash through their payroll. And they would decrease cash. So these are some examples of certain expenses. There's obviously more expenses, but this is the general way that it would work. Either the cash was paid before the expense, the cash was paid at the same time, or the expense was incurred prior to the cash being spent. So in this light, we're now going to look at transaction analysis, as you may recall from previous review sessions, and how they relate to operating activities. So if you recall, assets, right, A is equal to L plus E. That assets are equal, so what we own, are equal to the sources of financing. Where did we get these assets from? How do we pay for them? So we can actually break this down a little bit further. If you recall, shareholders' equity is actually made up of contributed capital and retained earnings. So contributed capital is the investment made by shareholders, while retained earnings is the profit or the earnings of the company that were not paid out to the owners. They have been retained in the company for future investment. So let's take a look at that, right? We're going to make a little T account for retained earnings, and we're going to show what would go in our retained earnings account. So we would have our beginning retained earnings every period. At the end of the year, we would add the net earnings of that year, and we would subtract any dividends that were paid out, and this would give us our ending retained earnings. But retained earnings, what is that built out of? Retained earnings is basically our revenues less our expenses. So in a sense, an increase to revenue acts the exact same way as an increase to equity. And an increase to our expenses acts the opposite way as a reverse to an increase in equity. So let's create T accounts for these two. So revenue account would increase on a credit, and it would decrease on a debit. An expense would increase on a debit, like an asset, and it would decrease on a credit because it acts the opposite way of equity, right? An increase to expenses is a decrease in your equity. And if you look here at your dividends, well, if you pay out a dividend, right, an increase to dividends is going to decrease your equity. So it acts in the opposite way as an equity account. And a decrease to dividends would be a credit. So an easy way for you guys to remember which accounts increase on a debit or credit, because you may be a little bit confused, there's a lot of accounts, I have an easy way for you to remember. And you just need to remember the word dealer. So dealer is your dividends, your expenses, and your assets. And these all increase on a debit, and they decrease on a credit. LER is your liabilities, your equity, and your revenues. And these increase on a credit, and they decrease on a debit. So if there is something important for you to remember, it is this, that is to remember dealer. So your dividends, expenses, and assets increase on a debit, decrease on a credit, while your liabilities, equity, and revenue increase on a credit and decrease on a debit. So just remember dealer, and you'll remember which accounts work in which way. So let's record some journal entries to practice what we've learned so far. And we're going to talk about which financial statements they would go on. So at first, let's purchase some inventory on account. So to purchase inventory on account, we would debit inventory, which is an increase to assets. So we bought $1,000 of inventory, and it was on account. So we would credit accounts payable, so it's an increase in liabilities, by $1,000. Now we have sold it for cash for $2,000. So first we record the receipt of cash. So we debit cash for $2,000. We credit sales revenue, which is an increase in shareholders' equity, by $2,000. And now we have to record, remember, according to the matching process, we have to match the inventory that was used up to generate these sales. So we debit cost of goods sold. So it's an increase to expenses of 1,000. And we credit our inventory, which we have used up by 1,000. And now that we've received cash, let's pay our suppliers. So we debit accounts payable. So it's a decrease in liabilities of 1,000. And now we're going to decrease cash, a decrease in assets of $1,000. And if you can understand why we've done all these entries and you understand the logic behind it, that's the most important thing here. Don't worry about individual account names, but just worry about understanding the big picture. Do you understand the logic behind each entry? So we have a couple of ratios that we're going to cover today. So we actually have a couple of ratios that we're going to cover. The first one is earnings per share, EPS, which I mentioned earlier. So earnings per share is our net earnings. If you remember, it's the bottom line of our statement of earnings divided by the average common outstanding shares. So there's a lot of words here that we're going to have to go through. Net earnings, you will recall, is the profit that the company generated. Anytime that you see average in a ratio, it means the beginning balance, so the beginning of the year plus the ending of the year divided by 2. So it's just asking for the beginning plus the end over 2. Common outstanding shares. So shares have many classes, and this is your common class shares. And on your midterm, the only type of share you're going to see is your common shares. And for the final, you're going to see different share classes, but at that point, you're all going to be pros and you're not going to be worried. Outstanding means that it is owned by shareholders. So it is currently owned. And shares, these are shares of ownership in the company. So for example, if a company had net earnings of $1,000 and on average, right, there were 100 shares owned on average, the earnings per share would be $10 per share. And the earnings per share shows us for every single share owned by shareholders, how much profit did the company generate? The next ratio is the total asset turnover ratio. And this is sales revenue, right? So it's the top of our income statement divided by the average, remember, beginning plus ending over 2, total assets. So this ratio measures the sales generated for each dollar of assets, right? So let's say we had sales revenue of $10,000 and we had, as our average total assets, we had $10,000 of assets. So our ratio would be $1, or would be 1. So it would mean that for every dollar of assets that the company had, we generated $1 of sales. So this measures a few things. It measures how effective or efficient the company is at using their assets to generate sales, and how efficient they are at controlling their assets, that they're not just letting their assets sit around there, they're using them to be as efficient as possible. An example we can give is actually our school, JMSB. We have a huge building, Concordia University has many buildings that are used heavily in the fall and winter. But in the summer, they're not used as often. So the school, for example, would look for ways to use their buildings and all of their assets in the summer to generate revenue for the school. So a higher revenue is better. A higher ratio, is better. And finally, we have our return on assets, also known as ROA. And this is our net earnings plus our interest expense net of tax divided by our average total assets. So This measures the earnings that were generated from the use of our assets. It measures profitability, and it measures how well the firm selects new investments. So why do we care about interest expense net of tax? Well, interest expense or financing costs, yes, the company pays them, but they didn't necessarily have to pay them. So if the company did not have any financing costs, how much money did we actually generate? So ROA is equal to net earnings plus interest expense. And how do you calculate it net of tax? Well, what you do is you multiply it by 1 minus the tax rate. And that will give you the interest expense net of tax. And you divide that by the average total assets. So these three ratios are very important, and as always, I'm not going to go too into detail about every single ratio. It's important for you to go into your book and to read about it and try practicing them. So finally, as always, we're going to end with an example about Java Joe, our good friend Cuppa Joe Cuppa, and we're going to help him with his business. So in our last session, as you may recall, we actually helped Joe to record the financing of his company, and he began to purchase assets. He hired some employees. He paid rent in advance. He bought inventory. And now Java Joe has actually begun operations at their location on Bishop Street. And it turns out students love coffee, so sales have been great so far. He's done a great job marketing the business. So let's help Joe record some transactions, and we're going to help him after that to build a statement of earnings. So what I really recommend that you guys do is, as I tell you each journal entry, try and figure it out before looking at the answers. So the first thing that happened, right? So in the month of January, we're going to say that Joe got set up, and now we're in February. So we're at the end of the month of February. So February 28th. So let's say that for the period, Java Joe had sales of $24,000, and they used inventory of $8,000 in this month. So why don't you try and record it? So their sales revenue were $24,000, and the inventory used was $8,000. So they received cash, right? So we debit cash by $24,000, and we debit sales revenue by $24,000. And the inventory used was $8,000. So the cost of goods sold was $8,000, and the inventory used was $8,000. So let's talk about it. Let's talk about what each account is. Cash was an increase to assets. We received cash. Sales revenue was an increase to equity. Cost of goods sold was an increase to expenses, and we decreased our inventory, right? It was a decrease in assets. Okay. Next, during the month, Joe paid employees $6,000 in wages. So we debit wages expense, so that's an increase to expenses, and we credit cash, so that's a decrease to assets, of $6,000. The next two entries are what we call adjusting entries. I don't want to get too into detail because in the next review, in part 4, we're going to be covering adjusting entries in detail, but I'm just going to walk us through step by step what these adjusting entries are. So if you recall in the previous review session, Joe had actually paid for some rent in advance. So we're going to say that he actually used up 2 months of rent, right? So if you recall, it was $1,000 a month rent. So he used up rent. So we're going to debit rent expense, so it's an increase to expenses of $2,000, and we're going to credit the prepaid rent that was used, so it's a decrease of assets by $2,000. And finally, Joe is going to pay interest expense on the loan that he took. So Joe had a loan of $20,000. We're going to say that it was a 12% loan, right? It's 12% a year, but we're only recording 2 months of the loan, right? Because it is January and February. So I'm going to show you guys what the journal entries will be, and then I'll show you how to calculate the amount. So we would debit interest expense. So it's an increase to our expenses. Now, he did not pay the loan yet, so it's going to be a credit to interest payable. So it's an increase to liabilities. Now, how do we calculate it? Well, the loan was for $20,000 times 12% per year times 2 months over 12. So that would give us $400. And we're now going to use this to build our income statement for the period. So, Java Joe, statement of earnings for the period, remember, because it is measuring a point in time. So for the period ended February 28th, 2017. So we're going to start off with our sales revenue. So what was our sales revenue? Well, we're going to go over here, right? And our sales revenue for the period was $24,000. And the next line in our income statement is going to be our cost of goods sold. So we're going to take a look, and our cost of goods sold was $8,000. So we subtract $8,000. So what was the gross profit for Java Joe for the period? The gross profit was $16,000. And these $16,000 is what Joe is going to use to pay every single other expense, and then keep a little bit more either for himself or to reinvest in the business. So we now have our operating expenses. So what expenses did we have? We had our wages expense, and we also had our rent expense. And interest expense is not an operating expense, it's part of our financing costs. So we're going to list them here. So we have wages expense and rent expense. So wages were $6,000. And if you recall, rent expense was $2,000. So we're going to add these two up. And this gives us total operating expenses of $8,000. So this gives us our operating income. So $16,000, right? Subtracting $8,000, that's going to give us an operating income of $8,000. So we're going to look back at our entries, and we have an interest expense for the period of $400. So interest expense, 400, and this gives us our earnings before taxes of $7,600. So right now we have our earnings before taxes, and we're going to now need to calculate our income tax expense. So we're going to put income tax expense, and we're going to say that our income tax expense is 20%. So 20% times 760. So let's take a look here, right? So we have 7,600 times 0.2 gives us 1520. So our income tax expense for the period is $1,520, and this gives us our net earnings of $6,080, right? Because our earnings before taxes less our income tax expense gives us our net earnings. So what we're going to do is we're actually going to record the journal entry for our income tax expense for the period. We're going to recognize the expense now. So we would debit income tax expense, and we haven't paid it right away, and we're just going to credit income tax payable. So it's $1,520. So we debit $1,520, credit $1,520. This is an increase to expenses and an increase to liabilities. So are we done yet? No, because we need to calculate our earnings per share. So for the earnings per share, if you recall, it's our net earnings, right? So our net earnings is 6,080 divided by our average common outstanding shares. We're going to assume that the company has 1,000 outstanding shares. So 6,080 divided by 1,000 gives us $6.08. So this means that every single share in the company generated $6.08 of earnings. Whether this is good or not, you would have to compare with other companies, but it's very important to not forget you always have to put your earnings per share at the bottom of every statement of earnings. So if you take a look now, you can actually analyze the company from top to bottom, and you can see every step of the way and where all the money has gone. So based on what we've covered today, you can see that for $24,000 of sales, the company has generated $6,080 of profit. So if you didn't try this already, I recommend you try it on your own. And if you did try and you got it right, great job. And if not, keep at it and just focus on understanding the logic behind every entry. That's the most important here. Don't worry about one step or the other. It's important to just understand the accounting system. So thank you so much, and we're going to see you in the next review session.